world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Ryan King is the co-founder and CTO of Chime, one of the leading digital banks in the US. Chime offers free banking to over 3 million customers, helping them save hundreds a year on banking and gain control of their financial lives. This episode was recorded at LendIt in San Francisco. A huge thanks to Peter Renton and his team for inviting us to participate. As listeners know, digital banking is a space we follow closely. The US is a fascinating market to watch, given the importance of spending, borrowing, and investing, prevailing incumbent pricing structures, digital penetration, and customer expectations. And with the number of well-funded fintechs converging on comprehensive digital financial offerings, including Robinhood, Acorns, Betterment, MoneyLion, Chime, Varo, and others, not to mention European digital banks like Monzo, N26 and Revolut, the space will get competitive fast. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Ryan King. Ryan King, welcome to Rebank.
Thanks. Glad to be here.
You're the co-founder and CTO of Chime. Tell us a bit about Chime.
Yeah, Chime is a modern mobile challenger bank in the US. Our product is simple, free, and easy to use. We have about 3 million accounts that we've opened up, which makes us the largest and leading challenger bank in the US. And we're opening up a couple 100,000 accounts a month, so I think we're doing something right.
Yeah, and so you mentioned free as a point of differentiation.
Yeah.
So for international listeners, can you just want to kind of describe the traditional offering here and what makes Chime different?
Yeah, for most Americans, they'll typically have a bank account at one of the 4 large banks, usually in the US, Chase, Wells Fargo, Citibank, Bank of America. And for most people in America, especially middle and lower income Americans, they're typically paying between $300 and $400 a year in fees for their basic checking account. We call it a checking account here. I know on the other side of the pond, you call it a current account. That's pretty typical. A lot of that comes in the form of monthly fees, overdraft, and overdraft fees is a big line item that a lot of people pay. When you get to the higher income Americans, ironically, financial services products get less expensive. And so we've decided we want to change that.
Yeah. And I think you have some stats on the kind of the average revenue stream for banks. I think you have figures to hand, don't you?
Yeah, you can see these in these are all publicly traded companies, and you can see in their earnings reports. For example, a couple weeks ago, Wells Fargo announced their quarterly earnings, and you'd see a line item in their quarterly earnings, which would be called something like service fees on deposit accounts. And last quarter, they reported $1 billion of service fees on deposit accounts. That's the money they're charging Americans for those Americans to give them their money.
So they can then lend it out.
So they can lend it out
and
margin. Make other sources of income on it.
Tell us all a bit about your background, because I think you've done some really interesting stuff and stuff that maybe informs some of your experience and expectations around Chime.
Yeah, absolutely. So my professional story starts when I graduated in the first internet boom. 1999, I graduated from Stanford with a computer science degree. And as I was just finishing that up, I was taking a class from Larry and Sergey from Google. It wasn't so much a class. The class was titled Search and the Web, both of which were pretty novel things at the time to be teaching a class about anyways. And it wasn't so much a class as they were trying to recruit kids to come work on their little basement project, which obviously worked out pretty well for them. One of the things that I worked on at the time was helping them. They were trying to build this link graph of the internet, which is sort of what became their secret sauce and how their search works better than most others. And so I was helping them work on that. And I, as part of the classwork, but then I declined to participate in their ongoing basement project because I thought, who needs another search engine, right? We have Lycos and AltaVista and Yahoo and Excite, and there was all these great search engines, so I didn't really see that the world needed another one. So I didn't join up with them, and instead went into the workforce, went to work for a startup at the time, which went public shortly after I joined, went to a 10 billion valuation, and then went down to zero. So I got to ride the ultimate roller coaster of sort of the .com, 1.0 bubble. Learned a lot of interesting lessons along the way. And then I joined up with Sean Parker, was later became one of the key people at Facebook. I joined up with him to start a company called Plaxo, which was early to the social networking game. We basically invented viral growth on the internet, all those connection requests and invite your friends and all those sorts of things. We were sort of the first ones to do that, and we provided a valuable product for free. We got to 20 million users without ever spending any money on marketing, which was a great success from a customer acquisition, having an impact and value perspective. We never really found a business model that clearly LinkedIn in the professional social networking space found. And so as a result, we sold the company shortly before the 2008 economic meltdown, which was well-timed because all the venture capitalists dropped their pencils right about that time, so it was good to have an exit. And then I met up with my co-founder, Chris, to start Chime a couple years later. And so I'm I guess in some ways new to fintech. I don't have an entire career in it, but what attracted me to the category was being able to have a huge impact on a lot of people's lives, but also having very clear ways that it could turn that impact into a business and have it sustain itself.
How important are kind of social and viral to what you guys are doing at Chime?
They're pretty important. We, financial services is, with a few exceptions, rarely a inherently social or inherently viral product category. The exceptions being, peer-to-peer payments, and you see some of that with, Venmo and in the U.S. and various peer-to-peer networks. But what we do find works really well is when you have a product that people love in a category full of really bad actors that are making it very expensive for middle and average and lower income Americans to have financial services products, people want to tell their friends about it. And so we get something like 30 or 40% of our new accounts opened come from word of mouth referrals and people telling their friends about Chime.
Yeah. As the CTO, I think you're the guy to ask about the way you guys approached the broader architecture of the business and kind of what motivated your, one, design decisions from that standpoint, and two, the decision not to pursue a banking license.
Yeah, the conventional wisdom was that you couldn't generate a profit from offering a free checking account. And the reason for that was the main four pieces that you need to power a checking account are, number one, you need a bank charter of some kind. In Europe and the UK, that's been a little bit easier for companies to go get those. And here in the US, it's very difficult. There haven't been any technology companies that have succeeded in getting a bank charter in the last 10 years, although that's starting to open up. So you need a bank charter, you need a core deposit system, sort of like the back end of a bank account. You need a card transaction processing system so that your customers can buy things in the world. And then you need a network like Visa or MasterCard or Amex Discover. And what we found when we were trying to enter the market was that what most companies had done before us and what every other startup and fintech had attempted to do in the past was get to market quickly by essentially buying all four of those pieces off the shelf, buying or renting all four of those pieces off the shelf. And the problem we saw was that the cost of renting those pieces in the US exceeded the amount of even uncapped interchange on debit that you could earn. And so we decided very strategically to cut out as much of the cost as we could in as short amount of time as possible. And if we wanted to cut out all of the cost, we would have got our own bank charter. We would have tried to build our own global payments network instead of Visa. It would have taken a really long time. So rather than try to do those two things, we just built as much of the technology stack in the middle to cover those pieces of core deposit system and card transaction processor as we could, so that we could lower the cost dramatically, so that we could go to market with a free checking account that actually generates a profit.
If you really distill it down, why did 3 million people decide to join Chime? Like, what's the one or two or three real reasons that people sign up and use it?
We serve primarily the 160 million Americans who live paycheck to paycheck. That's our target. We're really focused on that. And so that translates into the answer to your question, which I think is, what is the hook for Chime? Why do people sign up? And we get asked that question a lot. And right now, the hook that works really well for us is a couple of things. Number one, we give people their paychecks 2 days early. So most people get paid every 2 weeks on Friday. If you sign up for a Chime account, you'll have access to your wages on Wednesday. That's a simple to understand value proposition that resonates with a lot of people that live paycheck to paycheck. Number two, it's free, so you can use the account, and most of our customers use the account without any cost. And number three, we help people save money automatically. So one of the big stats I like to quote is something like half of all Americans don't have even $1,000 of emergency savings. And people know that, and they know that that's sort of finance 101, that you need to have an emergency savings account in case something happens, your car breaks down, what have you. But they don't know how to change their behavior to build it. So we give people tools to build that. And then the last thing that becomes obvious sort of once people start using Chime, that they love about it and keep using, that's obvious to them but less obvious to people looking at it from the outside, is we always let people know where they stand with their finances. And what I mean by that is we're sending something like 100 push notifications a month to their mobile app. Every time you wake up in the morning, here's your balance. Every time you do a transaction, here's your balance. Every time you deposit into the account, here's your balance. And so what that accomplishes for this segment of people who live paycheck to paycheck is it takes away a lot of the anxiety that goes along with living paycheck to paycheck. You're not walking into a coffee shop wondering if you have enough money in your account to buy that donut or coffee.
Are you say people living paycheck to paycheck, is that people in their 40s who are working blue-collar jobs? Is that 23-year-olds that are working their first jobs?
Yeah, we tend to skew a little bit younger compared to the overall population of the U.S. Our median age is probably in the 27, 28. So we're not talking about, for most of our customers, this is not their first bank account. Most people in this country, a typical story you would hear from one of our customers is they had a Wells Fargo account that their mom set up for them when they were 12. They never really had any costs associated with it, even in college. Typically, the costs will be low or free, even from some of the big banks. And then they graduate college and get into the workforce, and all of a sudden realize that they're paying a lot in bank fees and not being well served by the incumbents.
Mm-hmm. And one of the criticisms, I guess, or challenges that a lot of digital banks in the UK and other parts of the world get is around kind of primary account versus secondary account. Do you get the sense that your customers using Chime as a primary account, or because there's maybe a linkage option to an existing account as kind of a stepping stone, right? Yeah,
we do allow people to connect their existing bank account. That's more about facilitating trial and helping people move any money that they might have over. But the way we market it, and then the people that we serve the best are the ones that make us their primary account. And so almost all of our transaction activity is from people this is their primary, and in many cases only bank account. Something like only 25% of our customers are using us not as the primary account.
Well, the fact that you're saving them so much money clearly changes the dynamic compared to UK or other markets where they might offer free current accounts.
Right, and if you think back to my previous answer about what is the hook is get your paycheck early. That's one of the big hooks. So that only works if you put your paycheck into it. If you put your paycheck into it, by default, it becomes your primary account.
Yeah, sure. In terms of an initial value proposition, that sounds pretty compelling. You could either pay $300 or $400 a year, or you could pay nothing.
Right.
In terms of, I think one of the biggest challenges that banks have created for themselves, I suppose, is just the positioning vis-a-vis their own customers. So banks kind of sitting, intermediating the exchange of money and charging a fee for that. So on the one hand, it's about supporting financial flexibility and helping people achieve their financial goals, but on the other hand, they're actually extracting a bit of wealth as they go. So there's something of a natural tension there. As you think about where you expect Chime to go, other products that you expect to introduce over time, what's the best way to align in a kind of Chime's best interests and product set around the best interests and product set of customers in a way that feels genuinely like everyone's working toward the same goal?
Yeah, it's a good question and something that we think a lot about. And it sort of starts with our mission. The mission of Chime is to improve the financial health of ordinary Americans. And with that mission in mind, we boil financial health down to 4 different areas: spending, saving, borrowing, and investing. And very clearly we've started, and our wedge into the market is in spending. And for each of those product categories, we very intentionally and very thoughtfully align our business model with the mission. And so we were able to achieve that in spending by making a free account and taking out those fees and earning money primarily from Interchange. In the area of savings, we want people to have an emergency savings fund. We know that's good for them. We will do things like helping people create goals and what are they saving for in addition to an emergency savings fund. And for that, we'll look for that same alignment where, if our customer succeeds and improves their financial health, we want that to be the right thing for our business and vice versa. And then as we get into some of the other areas of lending and investing, we will, as we start to build out products, we'll look for ways to, again, align the business model to the mission. And that will probably mean doing things differently, as we've done with making a free checking account. And we're not trying to be totally prescriptive and totally big brother-ish about what everyone should do with their money, but we know that financial health is about smartly allocating across those 4 categories. And so as we build product lines and business lines that are aligned towards maximizing that health, we'll make that alignment actually genuine and not just something that we claim in our marketing.
Do you expect to kind of loop any of those kind of financial well-being supportive tools? I don't know, like kind of that positive data feedback loop, right? You have the insights based on not only the single user's engagement with their finances, but also the broader user set. And how can you be providing tools or layers or interfaces or notifications that are kind of nudging or helping people move in the right direction?
Yeah, it's a good question. I think when we think about financial health, we think about it really as a behavioral psychology problem. There's sort of 2 ways to change people's financial health. Either you can boost their income, or you can change their behavior on how they allocate their income. And we think a lot about the latter, and starting with capturing people's primary paycheck. That gives us a lot of power to affect their behavior about how they allocate it. And so your question was about tools and analytics and sort of PFME type of stuff. We're going to do a little bit of that, but we're making a stronger bet on automation and technology-powered automation to actually drive that behavior change. So if you take someone who lives paycheck to paycheck and spends everything they make and doesn't have any emergency savings, let's introduce some automation where all we have to do is get you to trust us and turn it on, and you believe that it's the right thing for you, and we'll take care of the rest. So that's sort of the vision. If you look at the most successful products in the history of time in optimizing financial health, in the US, we have this retirement construct called a 401k, which has been by far the most successful along that regard because it's automatic. Your employer takes the money out, puts it aside before you ever see it. And so we want to sort of take that same hypothesis of automation is the way to affect behavioral change and apply it across all those categories.
It's probably worth just digging in slightly to the business model, specifically the interchange component, and how the kind of the free account is funded. So for listeners who are coming from outside the U.S. and aren't familiar with the U.S. interchange model, do you want to describe that real quick?
Yeah, it's quite different in the U.S. versus most of the rest of the world, and that has created the opportunity for Chime as a business. And if the way to think about it is in the U.S., there are roughly 3 broad tiers of interchange that's earned by issuing banks. There's obviously debit and credit, different kinds of cards, but within debit, there's the interchange that big banks earn, and that is very similar to what you would see in Europe and across the world, which is something like 10, 20 basis points, something in that range. It's actually fixed to 21 cents plus 5 basis points is the actual cap. And so that's the interchange and that cap went into effect in 2012, not coincidentally the year we started Chime, because the effect of that cap as it was implemented in the US was that all of a sudden free checking went away for most Americans. All the big banks jacked up all their fees because they were used to making higher levels of interchange. So that's that's probably 80% of debit card transactions in the US are capped that way. And then there's the 20% of smaller banks and fintechs that are not subject to the cap, and those including Chime, and we enjoy about 1.5%, give or take, so about 150 basis points on debit interchange. And then you get into credit tiers where big banks and fintechs alike enjoy something much higher in terms of credit interchange, typically 2.5% to 3%, and that's what creates the high-end rewards credit cards that you see pretty ubiquitously in America.
Can merchants discriminate against kind of card issuers based on interchange?
They certainly can technically. They have the technical power to do so, but Visa strongly discourages it, right? You will largely not see different prices for things based on different payment methods. Occasionally, you'll see merchants that don't want to accept certain kinds of credit cards. It's actually not that uncommon to see in the U.S. small mom and pop shops say, we're not going to take an Amex Platinum. They'll even call out specific kinds of cards.
Because they charge higher interchange.
Because they charge higher interchange.
And that's how they pay for the benefits.
Exactly, right. But that's much more the exception than the rule. The rule generally that Visa pushes hard to enforce is if you're going to take Visa, you're going to take Visa, or if you can take MasterCard similarly. And as a merchant, you kind of have to make a choice, all or nothing.
Yeah. And you expect the interchange framework to remain as it is going forward?
For the near term, absolutely. I think there's been the political landscape in the U.S. There's been some talk about rolling back some of the regulations that went into effect post 2008 meltdown, including the interchange cap. So
that cap was kind of intended as a punishment for big banks?
Pretty much, yeah. It was snuck into this piece of legislation called the Dodd-Frank bill, which went into effect, which was passed in 2010 as an explicit reaction to the 2008 meltdown. It had many different components of it many of which were intentioned to prevent something like 2008 from happening again. But this one was sort of snuck in. It said, oh, well, the big banks make too much money and they're gambling our money away. It was part of this populist, too big to fail and Main Street versus Wall Street, all this sort of stuff that was going on back then. And let's, put a cap on the amount of interchange they can earn.
It's kind of classic, isn't it?
On debit.
Yeah, because it basically like doubled the cost of banking for the average customer.
That had the unfortunate for America, fortunate because it created an opportunity for Chime, but unfortunate side effect of every bank just jacked up all their fees, and then free checking went away for the middle class.
Yeah. One of the things that I, as listeners, will know, think a lot about and talk a fair bit about on the podcast is the kind of the evolving competitive landscape in, we call it broadly digital banking, but I think it also includes the likes of Robinhood and Free Trade in the UK, the kind of free stock trading app, the Betterments and Wealth Fronts, and other kind of pure play robo-advisors, the Monzos of the world and the Chimes who offer a transaction account plus card, and the broad expectation among pretty much everyone in the industry that everyone is kind of evolving toward the same end business model, one that's kind of a comprehensive rebundled bank, and that people kind of started with different entry points into the market as a way of building customer bases, and then kind of rolling out different products as they go to kind of support the economics of their businesses. I'd be interested, from your standpoint, as to kind of how you see things evolving from here. Like there's the question of whether it's helpful to have more customers and maybe be a free stock trading app, because then you can more quickly kind of roll out banking products and you've already got the customer base, or launch a new market with a strong transaction account offering and maybe a unit economic positive offering and quickly build a customer base. What are your views on kind of what the best entry point is and how that dynamic might evolve?
Yeah, it's certainly a really interesting time to be in consumer fintech. We like to joke that pretty much every consumer fintech now has the same 5-year product roadmap. It's just a matter of which product did you start with, but we're all trying to end, I think, at the same place, which is that rebundled bank, to use a buzzword. Your question was about entry points, wedges into the market. How does that play out? I think there's a lot of really interesting, cool fintechs that are growing very quickly. You mentioned free stock trading. Robinhood is an awesome company. It's gotten great traction with customer growth. I think, the classic bank playbook of the last 100 years has been start with capturing the primary relationship and expand from there. We've seen that work over and over and over again. For the first time now, you're seeing folks make a real shot at it coming from the other direction. Let's start with a lending product. Let's start with a stock, investing product. In some cases, even let's start with a savings product, like you got Marcus, and see if we can use that as an effective wedge to expand. One of the things that we think a lot about in terms of what is the right wedge into the market and the best long-term wedge is about engagement. So if we believe that the best wedge into the market obviously is the one we've taken, and the reason for that is if you can capture people's primary relationship and take good care of them in a way that where the business model works, and you're not having to charge fees and you're not having to do things that are misaligned with what's in the best interest of your customer, that it'll be much more easy to sort of, in a digital way, but follow the playbook that banks have used for decades to get them when it's time for someone to actually have some savings. They're going to open up a savings account with you. When it's time to get a loan or refinance some debt, they're going to turn to you more easily. And that the hardest thing to do is to get someone to switch their primary financial relationship. And so we decided to just tackle that, head on right up front. There's not too many examples in the US. I'm not sure about the rest of the world of people having success starting in with something that's not the primary account and moving upstream, as it were. Schwab comes to mind as maybe someone who has had success in that in the US. So yeah, I think there's a lot of excitement around the growth of a lot of these consumer fintechs, and you're seeing example after example of lowering cost or making something free being a big driver of growth. You see that with Robinhood. You see that to some extent with Chime.
Maybe it's a related question. What's your sense of the prospects of some of the European digital banks, the Monzos and N26s, Revoluts in the US?
Yeah, they're all coming here, right? That's what they all say, and I'm sure they will launch soon. We think those are all great companies. They have similar missions, and obviously technology focused. So we think that'll be really interesting and increase the competition, which I think will be good for consumers for sure. The way we look at it, the competitive landscape and the entrance of the European challengers into the US is, for the moment, for the short term, we're just taking customers from the incumbents. So I wake up every morning thinking about how do I switch more people from Wells Fargo to Chime. And like I said earlier, there's 160 million Americans living paycheck to paycheck. I don't believe that financial services will be a winner-take-all market in the same way that, Facebook took most or all of the market in personal social networking. And so I think there'll be room for a number of great technology-first companies to enter the market and take a good chunk of the share. To some extent, we also, awareness of the category, that there is an alternative to the Wells Fargo on the corner, is, we think, a really good thing. And as the leader in the space of challenger banking in the U.S., we think it'll sort of be a rising tide lifts all boats situation when N26 and Monzo and others launch here. And
in terms of what some of the incumbents are doing at the moment, you mentioned Marcus briefly before. Yeah. So Marcus and Fin, I think it's called, by JP Morgan,
Chase, yeah.
Kind of a digital banking proposition. What do you make of this?
Different opinions about each. I think the Marcus is really interesting. They've taken, obviously backed by Goldman Sachs, so they're looking to serve the real high end of the market. I think it's a great product for the high end of the market, and they'll continue to focus on that and do well there. If they're going after the top 5 or 10%, and Chime's going after the other 90%. So we don't really see that as terribly competitive, but I think nonetheless it's great to see that much speed on product innovation and execution from an established financial services company. So that's cool to see. I think when it comes to things like Fin, we've been a little bit more surprised in a negative way. Number one, that a brand like Chase, one of the most valuable brands and companies in the world, would feel that their primary brand is so tarnished among younger Americans that they would feel the need to launch something new under a separate brand. And
yeah, or they're maybe not fully committed to it.
It seems like that also. I know, for example, that it wasn't built in-house, and the strategy of basically taking a sub-brand and trying to use that to target millennials, and you just have pictures of people dancing at Coachella and emojis everywhere, and if you think that's gonna be all that it takes to reinvent yourself, I think it's not a great strategy.
And I have to ask, so the Apple Card announcement recently kind of took some by surprise, and I can imagine bankers kind of quivering at the entry of the entry of big tech into financial services, and this must be the first of hundreds of similar plays, and banking kind of disappearing, gobbled up by the likes of Google and Facebook and Apple and Amazon. Is that your sense? Because I guess in read in a certain way, it's also, you've got a device and then you have a card that's connected to it, and that is kind of what Chime is, but it sounds like there's some key differences.
Yeah, I think the Apple credit card product is going to be awesome when it launches. I'll certainly sign up for one myself. And I do believe that in the premise that software is going to eat the world, and especially in financial services. That's why I spend my waking hours doing what I do at Chime. The Apple product is, the Apple Card is also, backed by Goldman Sachs. It's, I think, going to be a high-end product. It's a rewards credit card, so it competes in the same space as some of the really high-end cashback cards that we see in this country. Chase has a Sapphire Reserve, Amex Platinum, et cetera. I think it'll be a killer product for that segment, especially because it's technology enabled and not just a piece of plastic or metal. But we don't really see it as directly threatening or competitive to what we're trying to achieve at Chime. Half of our customers don't have a credit card, don't want a credit card. They're living paycheck to paycheck. They're afraid of getting into debt. A credit card is dangerous for many Americans, and there's been a sort of secular shift among especially younger Americans away from credit cards recently. So I think a lot of Americans won't even qualify for a Goldman Sachs / Apple credit card. It's cool to see that they've tried to reduce the cost of that by getting rid of a bunch of fees, but it's still got a 15, 20, 25% APR on the credit card. So if you are higher income and you're able to manage your spending responsibly and pay off your credit card bill every month, it'll be an awesome product. If you're an average American living paycheck to paycheck, you probably either won't qualify or it won't be a great product for you.
What should people expect from Chime going forward?
Well, back to what I said in the beginning, our mission is financial health. We've got the 4 areas of financial health that we're trying to help people in and go after: spending, saving, borrowing, and investing. I would look for us to launch more products in all of those areas, especially the ones that we haven't gotten into yet. In the area of lending and credit and borrowing specifically, we see big problems with the way credit scoring systems work in this country, especially for younger generations, especially as those folks are shying away from using credit cards because they're afraid of getting into debt. It becomes a vicious cycle. Like you don't use credit cards, and therefore you don't build your credit profile, and therefore you don't have access to mainstream lending, and that's in many ways bad for people's financial health. So we're going to look to help people in the short term with improving their credit scores, demonstrating who's creditworthy and who's not in responsible ways. We actually bought a company called Pinch here in the U.S., a little startup that helps millennials pay their rent, and in doing so improve their credit scores. So that's kind of the direction we want to take it in the short term, and then obviously longer term we'll look for ways to lend responsibly to our customers who need it.
Excellent. Ryan King, thank you very much for joining us today.
Thanks a lot.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.